Welcome to lesson 4, guys. In this lesson, we will discuss what kind of trades I take based on the type of box and how you can use that knowledge in your own system and decide which trades are worth it based on what you're seeing on the charts. We will continue with the Roku example because that's the one that we picked up for the first two videos. It has all kinds of boxes and yeah, it was a beautiful trend, so it would be just a nice one to learn from. So let's begin. Let's begin with the base box first. When the price has been consolidating in a huge zone for months on end, we know that the first move out of it will be explosive, right? The only problem is that we don't know when the move actually begins. There are times when the price moves out for a little bit, and then comes right back. This you can see in Square recently. You can probably also see in the Amazon base box that's developing right now, in the Shopify base box that broke out a few months back. The price goes out of these boxes and then within a day or two, sometimes even right away, comes back because it's not ready to trend yet. Most of the times what's happening is the institutions push the price back in the box because they're not done accumulating. So that's a major risk with the base box breakout, and that's why when the price is breaking out of this base box, I don't like to take naked options on it. It's just not worth it because the price can come right back or it can chop around a bit before the break really happens. It's just not a quick, fast move which will make it worth it for naked calls and puts and be able to fight the premium burn. More often than not, I have faced losses when I'm taking a naked option out of a base box. So in this case, for example, when the price breaks above 170, above the base box boundaries, what I would probably do is take equities, take direct stocks, and another thing you can do is buy a bull put spread, right? Try and keep your strikes below the first zone because that's our stop. The price can still trend above this first zone. It can come back a bit and then still trend, right? The trend structure is not broken because a higher low can still be created. So if you put on a bull put spread, you will want to keep the strikes below the first zone. So those are the two possible trades I would take on a base box breakout. Now, the next thing I'll try to look for once the breakout has happened is sometimes the price will get out of the base box, and if it rises up really fast, it will move sideways for a bit. It will move sideways and consolidate and wait for the 9MA to catch up. This will lead to a 9MA box. An example is right here, between 270 and 280. You see price moved out of this 50MA box quick, moved sideways for a bit, and created a 9MA box. Well, from these 9MA boxes, you should be able to pick up naked options, right? From a 9MA box, pick up naked option for the nearest expiration, maybe at the money or one out the money, and it can be a quick trade. Maybe hold it 1 day maximum, right? Hold it for a few hours, take the quick trade, you will see 150% gain, get out. That's the goal of this. You're not there to wait, you're not there for the trend to continue, none of that. It's quick profits. So out of 9MA boxes, such as here, another consolidation right here, you should be looking at short term, very short term, the nearest expiration, long calls or short puts like naked options. That's it. You can also take a small bull put spread if you want. That also works. But again, you have to think about quick exits and the profits are not as much as you can make from the naked option in that case. In this case, I'm discussing all about bull put spreads and naked calls just because the breakout was higher. If the breakout is lower, just do the exact opposite of what we will do when the price is going higher. That's it, right? If the base box breakout, if the price goes higher, you will go long. If it goes below, you will go short. Same for the options. All right, so now that we have discussed the base box and we have discussed the 9 MA box, let's see how I will trade a 50 MA box. The first 50 MA box after the box breakout is a bit different from the second one, right? The first 50 MA box after the box breakout, which is a 9 MA box in the weekly, has a very high chance of continuation, a very high chance. And the move also happens rather quickly. So when you have a 50 MA box right after a big box base box breakout, I like to go big on these. I might put the usual position size for me is around 1 or 2%. In these ones, I might put 5%, maybe 10, depending on what kind of base box it is. If it's a Google or an Apple, yes, I will go big. If it's something like Doku or something else like mid-cap, I probably won't go as big. But I still like to swing for the fences when it's 50 MA, first 50 MA box right after the box breakout. And I will put 2 or 3 different types of positions. So if it's a first 50 MA box, yes, I will put some size on the equity, like directly buy in stocks. The second type of position I would take, for example, in this case, above 240, is I would buy long calls. I would long calls, maybe 1 or 2 weeks out, or at the money or one out the money strike rate. You see this quick move out? That's kind of what you can expect before a consolidation for 9 MA to catch up. This quick 2 or 3 day move out is how long I'm planning to hold the option. Right? I'm not planning to hold it for the whole expiration period. I'm planning to hold it for 2 or 3 days. It's still more than a 9 MA box where you only want to hold it for a few hours, 1 or 2 hours, maybe a day at max. This one you can hold it slightly longer. So that's the second position I would put on a 50 MA box like that. The third position I would put is a bull put spread. If the box is small enough, I would put it right below the box boundary, lower box boundary. If it's a bigger box, maybe I would put it somewhere in the middle of the box, still below the first zone, but in the middle of the box in order to get a bigger premium. So that depends on the structure of the box, and that is more of a nuanced question. It depends on the situation. But these are the 3 kind of position I would put on the first 50 MA box out of a base box. For a second 50 MA box, there is a higher chance of failure, so I won't go as big. Most likely what I wouldn't do is put more stocks here. Let me think what I can risk. I might put stocks here. I probably wouldn't do naked options here because there's a high chance of failure, right? If there's a high chance of failure, maybe the price comes back, chops a bit more. Maybe the price comes back and just goes down right away. In either of those cases, the highest loss possibility will be from naked options, right? Like the highest amount of premium burn. So we don't want to get involved in that. From a second 50 MA box or like a third 50 MA box, I would probably only put bull put spreads and just more equity. Again, your stops will be the first zone inside the box structure. That's non-negotiable. Where you want to take profits, that depends on you. As I said, the naked options, if I'm going long calls, I will just try to take profits right at the end of the first higher high, like around the first higher high. I'm not waiting for the rest of the trend structure to form, right? I will be patient with the equity and with the spreads because those are still gaining while the price consolidates. But the premium burn on long calls while the price moves sideways or pulls back to the 9 MA is just never worth it. So with that, my exit is probably the first higher high. I don't use this indicator too often, but I have found it's usually very good to figure out the figure out the first and the second higher high, right? So you can use it to take profits. It's the Keltner channel with a 2 ATR. A Keltner channel with a 2 ATR, you can use that for estimating where your first higher high will be and taking profits out of long options or short options, like naked options in general. That's how I like to trade all the three different types of boxes. As you can see, most of my trades are happening on the daily. That's my time frame. I might go down to 4 hourly to understand the little nuances. Maybe check out on the weekly to understand what the bigger picture is. But daily is where I'm making my trading decisions. I think that's it. That's how I deal with all these different types of boxes. That's how I trade. If you have any questions, feel free to email me or write in discuss in Hustlers University or in the War Room. And maybe in the future I will make more videos just based on the questions I will get. But that's how I trade this. That's all there is to it. I will see you guys in the next lesson.